Hello everybody, in this video we are going to talk about Japan. A lot of things are happening, so in this video I want to talk about the big picture of Japan, what is changing, and also I want to give you 4 stocks that could be potentially interesting if you want to invest in Japan because you think this is very bullish. These are great opportunities, and Warren Buffett is buying one of these 4 investment opportunities. It will be pretty interesting and pretty new. This is not a topic I often talk about publicly, but I'm following what is happening in Japan and in Korea because these are changing markets, and all the news that you see in this region of the world are bullish for stocks. As the S&P 500 is expensive, the Nasdaq is getting expensive. Some people argue we are in an AI bubble. Where do you invest? Well, if you want to have a hedge, you can invest in Japan or Korea. You have great opportunities over there. I think we can start. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade, and I have achieved a performance of 25% per year. And I am getting more and more interested in Japan and Korea. You have a new prime minister in Japan, and I want to start this video by showing you a short video. Okay, you have a great Twitter. Let me put this. A great Twitter post from Weston that says Masayoshi Son once bragged SoftBank Vision Fund raised $40 billion in 40 minutes from MBS. And damn, nobody pitches for capital like this. So we have a video of the new leader in Japan, and this is what she has to say publicly. Let me put the sound so you hear more clearly, and you will see. And ask yourself, is your leader talking about stocks like this?
Just shut your mouth and invest everything in me. Japan is back. Invest in Japan.
Japan is back. Invest in Japan. Thank you very much for your kind attention.
ありがとうございました。
Yeah, she dropped the mic. Okay, which is very surprising for a Japanese leader to say something like this. And this was during a conference, and also I want to talk about another video. She is quoting an anime, a manga. I think it was Attack on Titan. So an anime, to just have a quote to express how bullish she was for her country. Again, this is maybe the first time it happens for Japan. Something is happening. Something is changing. You have a clear new leadership that is extremely bullish for stocks.
Additionally, we will accelerate efforts, such as between Japanese and Saudi Arabian companies, to promote supply chain collaboration between companies. I have heard that Japanese manga and anime are very popular in Saudi Arabia. There are titles like Captain Tsubasa, One Piece, and Demon Slayer. But today, I would like to conclude my speech by borrowing a famous line from Attack on Titan.
Just shut your mouth and invest everything in me.
I believe you understand what I'm asking for.
Invest in Japan.
Japan is back. Invest in Japan. Thank you very much for your kind attention.
Okay, so that was for the broader context. Let me put this back to business. Okay, so clearly the tone from the new leadership in Japan has changed, getting more bullish. And if you look at the Nikkei, you will understand why. Nikkei 225. Here is the Japanese index. Now is in full force. Year to date, we are up 26%, more than almost everybody. You have a very nice performance since COVID, and we just reached an all-time high for the Nikkei, the Japanese S&P 500. And after 30 years of doing nothing, finally Japan is back. So this is a nation, a culture with a lot of pride, and this is the first time ever we have such a comeback. So they will do everything to maintain this comeback. They don't want their stocks to go down, and we are seeing exactly the same phenomenon for Korea with their new president, and they have a new leadership in Korea. Same thing, they have an objective for their equivalent of the S&P 500, the KOSPI, and they want stocks to go up. They want to boost businesses, force businesses to improve their earnings, to improve their capital allocation decisions. They want to force their Japanese companies to reward shareholders, to explain what they will do with their cash. Because the big problem Japanese companies have had for decades now is safety, hoarding cash. They have too much cash on their balance sheet and they don't do anything with the cash. So it's not good for their shareholders, but it's good for survival. So Japanese companies don't like their shareholders. They just want to save the cash and be safe, okay? Now the Japanese government is implementing new rules, and they have already started implementing new rules since 2012, then 2016, then 2020, and then 2023, and now today, 2025. They continue to change the rules, and they change the rules for their equivalent of the SEC, so the official regulation, and they are almost forcing companies to reward shareholders. Please use your cash. Explain what you are going to do with your cash on your balance sheet. You are almost forced to use this cash to do whatever you want, but use this cash to do dividends, to do buybacks, to do a special dividend, to do an acquisition, but do something. So yes, it will lead to some bad decisions, but they will force decisions. And if you only pick quality companies with the quality track record, you increase your odds of having an immense performance if you invest in Japan. I believe the Japanese economy right now, the Japanese stock market, is a good hunting ground. And I'm spending a lot of time analyzing Japan right now. And I think you should too. Again, I started this video saying, if you believe the S&P 500 is overvalued and you want diversification abroad, okay? If you want to focus on the US and tech, so be it. But if you want diversification, Japan is pretty good. The market is becoming extremely bullish, more shareholder friendly, and it seems like companies are embracing shareholder friendliness, embracing the joys of being a shareholder. So yeah, pretty interesting, and I want to talk about specific names today. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. So now I want to talk about 4 Japanese stocks that I think are worth your attention if you want to start digging into the Japanese market. I will show you some bullet points and then I will show you some financials, right? So you have a big picture idea, a clear understanding of what they do, what they sell, are they growing, are they profitable, do they have a lot of debt, these kind of things, right? So you can start your research over there. Okay, so let's start. The first one is Keyence Corporation, the automation profit machine. What it does is really simple. It develops and sells high-precision factory automation equipment, including sensors and vision systems. You have plenty of equivalents in the world, in the Western world, so nothing of a big shock. Is not a strange company. Very simple. We have plenty of equivalents in the US. The business model is a fabless model, so they design products and they outsource 100% of manufacturing, so it minimizes the capital expenditures, almost no capex. It uses a direct sales force for specialized consulting, maximizing value capture. Okay, now the pitch is fat margins. If you look at the gross margins, above 80%. Operating margins, extremely high. And the cash flow is extremely good. Okay, now let me show you what I mean. If you look at, I'm on Guru Focus right now. You can check. I mean, this is a free website. You can do the same thing at home. Keyence founded 50 years ago. Global leader in industrial automation, the company designs and manufactures a comprehensive range of high precision products, including sensors, machine vision systems, measurement instruments, control systems, lasers, digital microscopes, and safety equipment. You see, you have plenty of equivalents in the US and abroad. And the market cap is $80 billion. This is a large cap. The gross margins are at 80%, the operating margins are at 50%, and they have stable high margins. It's not as if they had an extremely good year. No. I'm on Fiscal AI right now for Keyence, and in red here, you see the gross profit margins for this business. For the past 10 years, gross margins of 80%. And for the EBIT margins in blue, 50%. For the past 10 years. Again, I love asking this question. Can you name 10 businesses in the US with this margin profile? You will have great difficulties finding 10, 15, 20 companies with such stable and high margins, okay? So extremely profitable. It seems like they are doing some great work and it is working. The revenue growth is a little bit up and down and kind of crazy, but the average growth rate has been 11% for the revenue growth rate and the median 9%. So you have a business growing 10% per year with fat margins, okay? You scroll down, what can you see? You can see that, look at this, the revenue is up and to the right for the past 10 years. Net income up and to the right. The free cash flow, look at this, up and to the right. Operating cash flow is the same. The yellow line and the blue line are the same, which means zero capex. Okay, so no meaningful reinvestment, no meaningful expenses. And they pay a small dividend. The dividend yield is 1%. And they don't have any debt. They are filled with cash. What will they do with the cash? As you have new reforms in Japan, what will they do with the cash? Well, it seems like they use more and more of the cash to do dividends. They will continue. So you have no buybacks for this company. And the ROIC is pretty good, 20% return on invested capital. What is the valuation for this one? Forward P ratio of 25. This is it. You have a stock that has declined. The stock price is at the same level that we've seen during COVID in 2020. A business that can grow 10% per year with extremely fat, high margins, doing a small dividend yield and no balance sheet issues. We are growing profitably. The valuation is a little bit expensive maybe for Japan, but maybe that's warranted because of the quality of the business model. You see, I don't see many YouTube videos talking about this company. It's a large cap and it's here. I mean, sometimes it's quite simple to invest in quality compounders. Maybe if it's too high, too expensive for you, you add it to your watch list and you wait. Because as the stock is dropping, you can continue to drop. What will be the bottom? Do the work now. Okay, that was for the first one. Second one is Hennge. I don't know how to pronounce this one, sorry. Cloud SaaS leader. So software as a service leader. What it does, it's a Japan-based software as a service, a SaaS provider. Its core product, Hennge One, offers identity as a service, providing single sign-on for multiple cloud services. The business model is a subscription-based business model. So cloud subscription business model. Again, the nature of the business model is pretty simple because we have plenty of equivalents in the US. Customers pay predictable annual fees. The sticky nature of identity management ensures high retention. So, high growth, we'll look at the growth later. High growth, high retention profile. Recurring revenue is more than 90%. Very high gross margins, very low churn rate, immense retention rate, and we are growing massively. Look at this. Keyence, I'm done with that. This one. Okay. I'm on Guru Focus right now. The stock has dropped meaningfully since 2021 and nobody wants the stock anymore. This is a small cap, micro cap, market cap of $200 million, market cap of $260 million. This one I could understand. It's much more hidden to find these kind of opportunities. I understand why nobody's talking about this one because, it's so small. It's tiny. Gross margins of 80%. Operating margins of 15%, net margins of 12%. And look at the growth. Revenue is growing every year up and to the right. Net income is growing every year up and to the right. The free cash flow is going up every year up and to the right. They are doing tiny buybacks. They have started doing tiny buybacks here and there. And as always, they have no debt. And now they will be kind of forced to use this cash. To do what? To do homework. I'm here to show you the way, not to deliver the investment case perfectly for you. For Japanese stocks, now it's your turn to start homework, to do the work. Okay? No debt whatsoever and filled with cash in cloud, which is a segment that is growing immensely. And for the valuation, same thing, forward P ratio of 25. Okay, perfect. Next one on the list. You have Mitsui Co. Well, we just talked about a small company that was hidden in the cloud segment. Mitsui Co. is the opposite of this. It's a large company that is not growing that much, but is focused on being efficient. Mitsui Co. Global Value and Capital Return. What it does, it's a Sogo Shosha. I don't know if I pronounced this correctly. So it's a big conglomerate, big trading company in Japan. It operates as a global investment and asset developer across energy, metals, machinery, and infrastructure. The business model is very much diversified. They do a lot of things at the same time. I see this as a big Japanese conglomerate. Okay, import, exports, these kind of things, providing exposure to global economic and commodity cycles. The key here is Warren Buffett has bought it. Okay. If you were not convinced because of these two bullet points, Warren Buffett, through Berkshire Hathaway, has been investing in Mitsui since 2020. Since, if my memory is correct, since August 2020. And then he doubled down on the position. He increased the position again in 2023. And I think he increased the position again in 2025. Okay? Maybe 2024, but you get my point. 3 times in a row, he doubled down. He wants to buy more and more and more. Okay, so Warren Buffett, the god of investing, the best investor of all time, is investing in this company. That's the pitch. I mean, that could be the pitch if you want exposure to the Japanese market. Okay, the focus is now on shareholder returns. You have large dividends and large buybacks. Okay, if you look at this company, the market cap is $80 billion. Again, it's a fat pitch. It's a large company. They don't have much margins because they trade volume and not pricing. Okay, let me scroll down. In terms of revenue, pretty stable revenue. Revenue has gone up since COVID. And since COVID, you have a high plateau. Net income is high, but not growing massively. Free cash flow has increased, but recently it has become stable. But the company is doing massive buybacks. If you compare this with the 2 other Japanese companies I talked about before, this company, Mitsui, is doing 4% buybacks every year. They are buying back 4% of their shares, 5% of their shares, 2% of their shares, 4% of their shares. Okay? That's very rare for a Japanese company. And they have some debt. They are reducing the debt level. So maybe they have reached a low plateau and they will not use the cash to reduce debt, which means more buybacks. And do they pay a dividend? Yes, they pay a dividend. Okay? You have an increasing dividend of 2 or 3%. 2 or 3% when the stock is at an all-time high. Look at this. The stock is up. When Warren Buffett, the god of investing, was investing in this one, you had a dividend yield of what, 5%? So you could have bought this company, 4% buyback yield, 5% dividend yield, and at the time the valuation was low. Now the valuation is still low. You have a PE ratio, forward PE ratio of 13, which is reasonable. And you will be in the same team as Warren Buffett. So if you want some safe exposure to the Japanese market and you think this company will continue to reward shareholders, which is the case, and which Warren Buffett thinks is the case, you can invest in this one. Now your turn to do the homework. Next one, and the final one, JFE Systems. Japan is a digital transformation play. What it does, it's an IT services company. It builds and maintains complex IT systems for large industrial and manufacturing clients. You know this very well. Japan is an old country. You have old companies. If you look at where are the oldest companies on earth that are like 500 years old, a lot of them are in Japan. As I told you, the vision companies have for Japan is survival. It's not shareholder friendliness. No, it's survival. So they just keep the cash in the balance sheet and they are safe. They have cushion in case you have a crash for some reason. So they favor survival, and which means a lot of companies in Japan have an old IT system. And this is a company that will implement a new modern IT system for plenty of companies in Japan. The business model, okay, historically it has served its parent company, but now it is using that specialized industrial knowledge to win highly profitable contracts with many other large companies outside of the parent group. The pitch, that's an undervalued play on Japan's mandatory digital transformation wave. Most large large Japanese companies use very old IT systems called legacy systems. This company is paid to replace and modernize these, creating a massive long-term demand. Japan is a big market that will become a very modern market. I mean, it's already a modern market, right? But you have plenty of old companies. And add to this, you have some financial discipline. So let me show you what I mean. Okay. JFE Systems, Computer Integrated Systems Design Company, blah, 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 planning, design, development, and maintenance of computer systems, blah, 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 blah. Well, you have understood me. It's a business that helps old businesses modernize their IT system. And it is a small cap, which means nobody is talking about this one. $400 million of market cap. Okay? And if you look at the margins, decent margins, 20% gross margins, operating margins of 12%. This is decent, not exemplary, but decent. Look at the growth in revenue. Stable and growing revenue over time. Not crazy growth, but sustainable growth. Net income is following the same trend. Net income is growing more rapidly, which means better earnings, better margins over time. Net income is a definition of up and to the right. The free cash flows, up and to the right. Operating cash flows, up and to the right. Do they pay a dividend? They pay an increasing dividend. The dividend yield is now 3%. Okay? And they don't have any debt whatsoever. They are filled with cash, especially recently. They have a lot of cash that they can use to pay dividends. No buybacks whatsoever. And look at this, the ROIC trend. ROIC, return on invested capital. ROIC is increasing from 8 to 10 to 12 to 19%. So the efficiency is growing, revenue is growing, free cash flow is growing, net income is growing, no debt problem, available at a PE ratio of 12. It's not even the forward PE ratio, it's the PE ratio. So the forward PE ratio should be 10, 11. It sounds appealing to me. And everything with a dividend yield of 3%. Okay? The stock has been on a run. On a year-to-date performance, we are up 35%. And still the company is not expensive. If you look at the stock price for the past 10 years, up and to the right. And if you think this big tailwind of modernization of the IT infrastructure will continue, maybe they will continue in the future. They will continue to grow revenue, earnings, free cash flow with a forward PE ratio of 10, 11. And nobody is talking about this company. Market cap of $400 million. And they have more than $100 million in cash. So 25% of the market cap is in cash. I like the odds. I like the odds of this one. So I know I will continue to do the research on this one. But these were 4 Japanese companies that are pretty interesting right now. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.